Okay, 2:07. Time to move on. So to get going, so let's have a introduction to financial system. 4 kind of subtopics. First, why study? Why these financial markets and institutions would be important, worth studying. Second, take a look at kind of the Finnish financial market, kind of which are the big institutions, which not so, and question, why do financial intermediaries exist in the first place? And then the big questions in bank regulation. We'll come to the regulation later on. Regulation overall, I see some of you might think that it's not that kind of a sexy of a topic, but it is pretty interesting of a topic as so much has happened, and all the bank regulation indirectly influences the financial conditions on which companies operate, and we all operate as customers of financial institutions. Could be bank, could be a mutual fund company, could be insurance company, and so on. First, some questions at the end of the lecture. So I thought that at the end of the lecture, we would come back to these questions, which are first, how large is the market for banks and other financial intermediaries? How big of a market are we talking about? Is this something of a minor size or something big? Why banks are so important? Pretty big proportion of the beginning of this course, we'll discuss about the banks. Then insurance companies, funds, and other institutions come later on. But banks make pretty big proportion of this course contents, as we will see. There's something kind of... we did not see new slide. Is it my problem? Is it? Can others see the slide? Sorry. Can you see the slime? Sorry, I kind of, let me see. Sorry, my bad. My bad. Let me kind of stop sharing. So another try. Now you can see. Good. Good that you were awake. I'm trying to follow my own lectures here on my kind of other screen, but now I forgot to do that. So questions at the end of the lecture that will return to this. How large is the market? Why banks are so important? Why banks are covered so extensively during this course? And then one specific question that has to do with banks. Why banks are bailed out other than, say, industrial companies or households, so normal people. When a financial crisis hits, why banks are bailed out and not unlike different other institutions. Everything good now? No worries. Oh, no. I don't see them. Can you? But you can see them now. Yes, good. Okay. Why study? Why? You might say that, Vesa, you are a finance professor. Of course, you find it interesting, and that's right. Fair enough. But the reason why I find this field so, and the reason why I'm a finance professor instead of, say, marketing or any other field, is that this is the most fascinating field that I think that anybody can imagine. So we are talking about institutions that influence our life every day, even any of us, not to mention big companies, not to mention governments. And what makes this even more interesting, this is, as I said, that in 1995, when we first started delivering a course, something like this. It was about different financial institutions, as I mentioned when we started. So in 2000, currently that's just was of the past weekend, the biggest annual event among economics professors and finance professors is American Economic Association and American Finance Association. They're having a joint kind of annual conference, which is organized obviously annually on the first weekend of a year in some American kind of city. That is the biggest thing. That's where the head of the central banks is. That is 3 years ago, I happened to meet Janet Yellen there, kind of as anybody. That is the biggest event for academics and for, say, semi-academic, so central bankers, practitioners. So there, the big thing is the presidential address. So that is the biggest thing, kind of as one, the speech that was given by then 2000 by Franklin Allen from Wharton, who asked that do financial institutions matter? And he explained that you may be surprised that institutions play little role in financial theory. So it's not only that the taxpayers or regulators have learned how important the incentives and strategies of different financial institutions are, but the global financial crisis taught us that we should have put more emphasis on these earlier. Okay, it's not too late, but now we are trying to recover we are recovering from this global financial crisis. And what we, for example, as one is we'll discuss about this separately, but something that nobody, not in the US, not Fed, no whatever, European Central Bank, nobody thought or nobody wrote about was that there could be something called systemic risk in the financial sector, which would have influence on not only financial world, but also, say, industrial world. So financial world typically is kind of called the Wall Street. So what happened is Wall Street typically has direct consequences on the Main Street. So that is the real world, real economy, real companies, real individuals. So a lot has been learned over the recent a bit more than 10 years. These financial markets, while they function well, we don't put too much emphasis on those. So Misken and Eaker say, this is something that I forgot to mention explicitly. I mentioned this in material. Misken and Eaker, the course book. So that is something that is American-based book. It's good book as such, but that is a book that you can use as a supplementary material. I'm not going to ask in the exam anything from this book specifically for two reasons. First, I have the feeling that I can't ask you all to buy the book. The second thing is that it's pretty much American-driven or American-oriented, even though it claims that it has some international dimension, but they have pretty little. And we are having more or less kind of European perspective. Obviously, we follow what's going on in the US market as well, as all the markets are interconnected. And especially the Inside Job movie kind of highlights how what happened in the US also had consequences on other even countries, kind of in different parts of the world. So this book is supplementary material. So you might take a look at if you find to get a kind of a deeper understanding on some specific topic. This picture is from that book. And this is something that you mostly have already kind of seen in introduction to finance course. So the financial market, the financial intermediaries play a very important role as they are between the lenders and savers. So that is the surplus sector of the economy, and then the borrowers and spenders. So on the right side, So here we have, these are the operators in society who have, you could say, more ideas than money. So companies have business ideas that they need financing, and where do they find the financing from is from somebody who is representing the surplus sector, more money than ideas. So typically households, people who work, earn more than they need for their everyday lives. But I personally need to save for my retirement. I need to save for some other purpose. So that's why I need to put my money to work somewhere, and then depends on kind of what I like. I might be kind of accepting a lot of risks, so then I invest in the stock market. I can buy shares directly from the stock market. I can buy mutual fund shares. Some proportion of my assets, my savings, I will have the bank account anyway. Somebody might be more risk averse and keep all the money on a bank account. Just as an example, in Finland, currently more than 100 billion of retail money is on a bank account. Over 100 billion, which is a lot of money. So that is something that these households have surplus, which then banks, as financial intermediaries, are lending to businesses, could be governments, to households as mortgage loans, could be foreigners as well. So if you just think of kind of that, is this financial system really needed? Do we need these financial intermediaries? Just think for a second or for a minute that we wouldn't have banks at all, or we wouldn't have the stock market at all, or we wouldn't have, say, mutual funds. Okay, life would continue as it somehow anyway, but obviously that would not lead to efficient flow of capital from the surplus sector to the deficit sector. So companies would have a very difficult time in finding kind of financing for their investments. Households kind of would have difficulties in finding a loan that they can buy a new home or whatever. So the more efficiently this financial market operates, so the easier it is that good ideas will get some finance. This is another picture from Misking and Eakins. You could classify financial intermediaries into depository institutions, such as banks. A commercial bank, Aktia, is a bank. Their primary liabilities or sources of funds, how they finance the operations, is through deposits. And how the primary assets, how they use their funds, is that they provide business and consumer loans, mortgage loans, or housing loans. It could be some other loans. So that is how banks are operating. We'll see that banks also finance the operations by issuing bonds, for example, but deposits typically are the major source of financing of the operations. Life and insurance companies, they collect premiums from the policies, and they invest those in corporate bonds, mortgages primarily. They can invest somewhere else as well. Life and casualty insurance companies, will discuss about insurance companies separately. Pension funds, government retirement funds do collect employer and employee contributions and invest that money to corporate bonds. We'll have example of this when we discuss about the Finnish financial sector. I assume that most of you are students, but whenever you enter the job market, as that is where I am, I do get a monthly salary from the university. Not only I pay taxes, but the the university management kind of takes from my salary a fixed 25 plus minus % every month, and that money is being invested in the pension fund system. That is something, it's a tax-like system. I can't influence that at all, but that is being taken out of my gross salary, invested in the system, that whenever I will retire, that will be kind of in more than 10 years' time. So from that pension fund pool, then the pensions will be paid. So that is even though, as I just said, that from my salary, I could save something, so that is that I can influence myself, but that is a pretty big proportion of my monthly salary is being saved for future use, and that is a pension payment. Pension systems are different in different parts of the world. This is the Finnish system. It's a mandatory system that I have nothing to say how much I would like to save and how this is being invested. American system is totally different, and that is something that we discuss when talk about the insurance and pension fund market kind of later on. Mutual funds, money market mutual funds are being collective vehicles for everybody to invest. Mutual fund assets are being then allocated to stock market, bond market by the fund manager. Money market mutual fund money is being, savings are being invested in money market instruments. Hedge funds are animals of their own. Private equity funds you could also add here. We'll talk about hedge funds and private equity funds also later on. Talk about the size. This is from Michigan, taking very quick look at. Obviously, there's no point in you kind of trying to figure out these numbers, but this just to highlight that banks really are dominant in terms of size. 2015, the size in billions was 70,000. This is the US. Sorry. The second largest financial institutions in the US were mutual funds, and that's the size in 2015. If you look at the growth from 1990, so the growth has been massive. Pension funds are also big, massive, especially in the US. The next picture, it's a bit dated, but I couldn't find a more recent data, but this is good enough for us. It illustrates two things. First, it illustrates how banks are the green bar, highlighting the size of banks relative to the GDP. First of all, we are talking about 250, 300, 350, 400. So talking about the size of financial market, banks only in some markets make 2, 3, 4 times the GDP. So banks are massively influential in our economies. That's one reason why to study, why to understand how banking sector works. That's one lesson from this picture. Another lesson from this picture is that countries are very different from each other. If we take a look at US, the US banks are not that big in terms of the size relative to GDP. They have other financial institutions, such as say mutual fund market, mutual funds, and other financial institutions. They are bigger. While in the Euro area, UK, Japan, you could say also Korea, so banks are very big. One chat question too. Do these figures? No, that's a very good question. My understanding that no, question was that do these numbers include financial derivatives? And my understanding that no, these simply are the balance sheet values, such as banks, for example. The balance sheet values. Derivatives are typically off balance sheet items. So, and that is a to-the-point question, as we'll probably kind of well discuss about kind of derivatives, financial derivatives. The role of financial derivatives is very clearly highlighted in this inside job movie, the regulation, the size. It turned out when the global financial market faced the crisis 2007-8, that we learned that the derivatives markets, the size was greater than the CDS market was greater than 50 trillion. Okay, what is a lot of money? What is a kind of not that much? So 50 trillion is pretty much, global GDP is around 90 trillion, so 90,000 billion. And this 50 plus trillion worth nominal value of derivatives was not in the balance sheets of banks. And it became like a bit like a surprise for the regulator especially, and also for the banks, that different financial institutions do have these different out of the balance sheet commitments called derivatives. And the magnitude was especially kind of the worrisome. Lehman Brothers was very big in derivatives, and that one of the reasons why the word, the term that was used was that the global financial markets got frozen. So they got frozen because the Lehman Brothers, who was big in derivatives, went bankrupt, which meant that they could not fulfill their commitments in these derivatives. Derivatives are essentially, derivative market is a zero-sum game. So somebody's winning, somebody's losing. Now, as Lehman Brothers went bankrupt, so they could not pay their share in these derivatives contracts. And the question was that, okay, if Lehman Brothers was losing something and somebody was winning, while Lehman Brothers went bankrupt, so they couldn't pay anything. So how about the other side of this transaction, which then, as this movie very nicely highlights, as Goldman Sachs was the counterparty to Lehman Brothers in some of these contracts, and they obviously had counted that now as they are winning, they expect that they will get paid from the derivatives positions that they are gaining. If Lehman Brothers had not been able to pay, so it could have led to a domino effect that some other banks, such as Goldman Sachs, had been kind of collapsing as well. That was prevented thanks to interventions of the central bank. That was a big thing. Then the question was that which banks were saved and which banks were not saved. That is a question that this movie is about, and that is something that we'll discuss then next Tuesday after Aktia's kind of Mikko's presentation. But derivatives are not in these numbers, even as sizable they are. Okay, this is the picture that I found, a recent one from McKinsey. Great picture, but I underlined here a complex system. So the global financial market is a relatively complex system, but this picture is great. As it highlights first, sources of funds, 304 trillion. And I just, for your reference, added here that global GDP is 90 trillion. So the global financial market intermediaries is more than 3 times the size of the global GDP. So it's if you're asking me that why study financial institutions and intermediaries, I say, okay, look at this picture. Obviously, this is the huge market. This is the sources of funds, and this is the uses of funds. And here is the global banking revenue, which makes something like 5.5 trillion is the global kind of annual revenue of global financial intermediaries, 5.5 trillion. So we are talking about a lot of revenues as well. Lesson number one, we are talking about the massive amounts of funds. Second, here is on the bottom of this page is on banking balances. So this is the banking sector. So banking sector, banks collect these personal deposits. So these are banking deposits. Banks also finance the operations by issuing bonds. They have some equity, so some share capital, and they could also have, they obviously have some corporate and public, so companies who have some deposits, governments, whatever, public institutions do have some deposits. This money is being channeled to corporate and public loans, retail loans, and some other securities being invested, and so on, through different mechanisms. So banking sector makes roughly 50% of the whole market in terms of the volume. Then upper 50% of this picture is about sovereign wealth funds, retail assets under management. So this is households, retail, kind of normal people investing in mutual funds. It's about insurance and pension funds and other assets under management. Being invested in equity markets, government bonds, corporate bonds, securitized loans, and other investments via private capital, brokerage companies, asset management, bank assurance, which is the combination of banks and insurance companies, wealth management services, retail asset management. So this just shows how sizable the market is and how different institutions have different roles in this ecosystem, you might call it, and from which they obviously kind of collect some revenue. So sizable market and many different players playing different roles. You could say also here's a marketing infrastructure, listing, kind of this, the stock exchanges, clearing and settlement, securities services, these are needed. There's not that much money being kind of, if just think of, say, fee-wise, you trade shares at the stock exchange. So stock exchange takes some proportion of the trading fee, but that is, you could say, 0.00 something. So that's, you could say, minimal, but that is obviously necessary. The biggest proportion of this fee, trading fee, goes to the broker. Any questions, comments concerning this? Shall we move on? The Finnish financial markets. This is just a picture showing kind of a highlighting kind of in a nutshell, the banking sector and mutual funds and life insurance companies. So what we can find here is that first, take a look at deposits, how banks have financed their operations. This is from 2017. Households, this is Finland only. Finnish household in 2017 had 85 billion in bank deposits, mostly in overnight deposits. As I just mentioned a couple of minutes earlier, today, this is more than 100 billion. So that is sizable chunk of money. This money then channeled to customers in terms of loans, mostly back to households. So, and biggest proportion of that goes to housing loans. So banks operate as financial intermediaries, taking deposits from households and lending that back to households in terms of housing loans. Some of those loans are being provided to non-financial corporations, so company loans, some and more so to housing corporations. But the big numbers here to keep in mind is that banks, majority of the bank financing comes from household deposits, and the biggest loan, the user fund is housing loans back to these households. Mutual fund market the size of the market was 110 billion. I added here a more recent slide. See the next slide. Let's take a look at the next slide. This is more recent development of the mutual fund market in Finland. 2010, the market was something like 40 plus billion. Currently is something like 160 billion. Equity funds, bond funds, mixed funds, or called balanced funds also, and some other say money market funds or hedge funds. Some don't play that big role in the Finnish market. As a reference, the Finnish GDP in 2018 was 234, currently is a bit more than 250. So we also talk about pretty sizable institutions in the Finnish market. And then life insurance markets, we'll talk about these separately later, talk about 50 billion, mostly personal policies. So people taking a life insurance policy from insurance company, paying premiums and save for their voluntarily save for their retirement. More or less, this is the market. The biggest chunk of assets in the Finnish economy is in the pension system. So we'll talk about this separately later also, but it's already at this point good to recognize that the biggest owners of the market and investors in the market are pension institutions, which are four major ones: Elo, Ilmarinen, Varma, and Veritas. This is from June last year, at the end of June. Ilmarinen and Varma, they are managing something like 56 billion euros worth of investments. Roughly 50% of that invested in equity investment. So whenever you look at big companies, big Finnish companies, kind of top owners, most probably you will find Varma and Ilmarinen as owners. These are private companies, or semi-private, you could say, because the money that they have been collecting is a tax-like payment. And two other, well, these are managed in the private companies' pensions. So the public ones is the local government pension fund, which is called Keva, used to be Kuntien eläkevakuutus, and state pension fund VER, Valtion eläkerahasto. They are managing 64 billion and 22 billion worth of investments. So all these together make clearly more than 200 billion. And if you compare this with the Finnish GDP, which is a bit more than 250 billion currently, so you can see that pension institutions in the Finnish kind of setting are very huge players in the markets. Why do these financial intermediaries exist? This was the picture. This kind of already highlighted that. And I said that you could think of the world without these financial intermediaries at all, but the more we have of them and the better these financial intermediaries, more efficiently the market works, the better we can kind of allocate our savings. Kind of consumption timing, I consume less currently than what my net salary is, so I invest that kind of later for my retirement years. I can allocate my investments, I can manage them, I can pool risks, I can invest in, say, mutual fund, which is a pool of different assets if I like, or I can invest directly in Nokia shares if I like that too. There are many different alternatives available. There's a separation of ownership and management. So if you think of a listed company, so or say a very big company, kind of a billion euros company, so they might have most probably they will have a hard time in finding any one family or one individual financing them, so they become listed. The ownership is becoming more dispersed, diversified, and so that we can solve kind of the agency problems. Kind of they're listed, they are committed to the requirements of the stock exchange. They are committed to inform investors about their performance, like it or not, but they need to kind of provide profit warnings when the performance is worse than expected, or profit promises, as Nokia kind of did this morning. Kind of they announced as a separate stock exchange release that they have found out that the performance last year was better than what had been communicated earlier. So information must be symmetrical, so that all stakeholders, all shareholders know that the information that company is providing is timely and valid. That is the information. We all know currently kind of that Nokia is doing pretty good in terms of business and providing liquidity. Anybody having Nokia shares could easily sell it today or buy more. So that is what financial market provides us as a service, you could say. And this in turn provides companies the vehicle to finance their operations. They need to commit to these rules, but once they are committing to these rules, they issue shares through IPO, and then later on they could have additional kind of share issuances, stock issuances, so they can finance the operations and get financing cheaper, because investors are willing to pay more for these listed company shares than unlisted, because investors know that we get the liquidity, we can get rid of these shares if you like, we can buy more. So we require lower liquidity premium for listed companies. That's why listed companies are the reason for existence of stock market is that companies do get financing in better terms than from the private market. But as you can see, Volt, as an example, did not choose this IPO, but they went the other way to grow bigger. They were acquired. They accepted the offer to become a part of the bigger company, while Deliveroo chose to go through this IPO route, and now they are publicly listed and open to kind of to public criticism, obviously, which is what public companies need to be aware of. Very quickly, kind of the role of banks. Banks as kind of they are a bit different financing intermediaries than others. They also channel funds from the surplus sector to the deficit sector. They channel these bank deposits to somebody needing a loan. They do this size transformation, maturity transformation. So bank deposit typically is a very short time money, overnight money, but banks do provide their clients, say, 20 years mortgage loans. At the risk, this results in a risk position of a bank, and risk management is the integral part of the bank's business. That is bank's core business, to manage this, say, maturity risk, for example. The basic concepts, information asymmetry is very core in the banking sector. Somebody has a private information about kind of, I know best what how I am doing or my company is doing, and whenever I go to a bank and ask for a loan, the bank knows that Vesa knows the best, and of course I have an incentive to to be transparent, but also kind of to get financing cheaper, I might have a kind of a tendency to show my business case more optimistically, more positively than what the true case is. And bank understand this, and that's why they need different screening and monitoring credit analysis tools. They might ask collateral. They might limit the amount that they are willing to lend me. Regulation is meaning, and this is something that we'll discuss. Now we come to the very core, and this is the last point that we discuss this lecture, banks' incentives. So as bank deposits are so dominant in terms of banks financing, so we as customers, so we need to have these deposits as we need to access to the payment system. So without banks, so our everyday life would be very complicated, very, very complicated. And these deposits they're very simple. I just deposit kind of some proportion of my savings on the bank account, and that is totally liquid. It's risk-free, and that is, I don't think about it. That is, why should I worry about kind of the risk of a bank? Bank might think that, okay, this money is that it's almost guaranteed. Customers are not interested in how bank is being using the money, and of course leads to an incentive kind of a challenge that banks might, well, they are private companies. So the more risky investments they make with this money, the greater the profit. So they might have an incentive to take excessive risks with the depositors' money. And that is at the heart of the banking crisis kind of discussion, as we as customers, we treat our deposits as risk-free. We don't even think about kind of how the bank uses the money. And if it happens that the banks, after taking too much risks, the risks would realize and the bank would collapse, would go bankrupt. So that would effectively mean that depositors would lose their savings. And this is something that is typically considered to be impossible to happen in well-functioning societies, as if this would happen, so after that, we would no longer be willing to provide our savings at the, say, zero interest rate for the bank's use. And that would be harming the whole society. So the money would not be, the banks would no longer be able to lend the money for the households in housing loans of corporations. So that's why governments typically do guarantee bank deposits, so that depositors don't need to worry about how these banks are, how risky businesses they are doing. And this, of course, leads to the regulators' role being kind of becoming more and more important, because as long as the government is providing this guarantee, so they need to, the society, the regulator needs to supervise these banks to prevent them taking too much big risks, to prevent something that happened really in 2008. As Bert Bernanke, who was the chairman of the Fed, then said that I've never been on Wall Street. I care about Wall Street for one reason and one reason only, and that is because what happens on Wall Street, meaning financial sector, matters to Main Street. And that is, it happens, it influences us all. Next question is that big questions in bank regulation. Should banks be regulated? Yeah, they must be regulated. But then the question is that who should regulate and who should supervise banks? How to set optimal capital requirements? This is something that we'll discuss during this course. Are there other requirements, such as liquidity requirements? What is the optimal level of deposit guarantee? What is too large to fail as a phenomenon? Should bank structure and operations be regulated? Or or not? And then the question, who should pay for these regulatory costs? So these are the questions that are at the heart of banking regulation, and this regulation, which has been becoming more and more tough since 2008 global financial crisis. This is something that banks are complaining every day. Any questions at this point? Is everything clear? If not, there's something in chat. Thank you. Okay, thank you. Please if you have anything, please let me know. You can send me email whenever. Any clarification, anything you find from financial news papers or media, something that has to do with financial regulation or financial intermediaries recently. But whatever happens on Thursday, we'll continue about what really happened in 2008 and how we are getting out of that. How was it happened? How was it able to happen that Lehman Brothers really went bankrupt? How it was supposed to be impossible that it really happened. And if it happened once, can it happen the second time? If no other questions, I thank you for this. I encourage you to start the casework and term paper as soon as possible. And I hope that you find group members. And I hope that you find the cases at the term paper interesting. If no other questions, thank you and see you.